Good afternoon.
Poštovani novinari, dame I gospodo,
Esteemed members of the press, ladies and gentlemen, my colleagues who are necessary today in order to present the inflation report, and to all those who are following this through usual means, I wish to greet you all, and I want to apologize for the way in which we are holding the presentation without the remainder of our colleagues. We're doing this from health concerns and from the caution necessary in order for us to be able to respond to all our duties. On my right is Dragana Stanic, Vice Governor, member of the Executive Board, who is here with us today. So if you have any questions for her, we would like her to participate as well with Mr. Željko Jović, Executive Board Member in charge of financial institutions. For any questions relating to banking supervision and other financial institutions, we have Mr. Darko Stamenković, General Manager of the Banking Supervision Department. Of course, you already know Mirjana Miletić. This is our Economic Research and Statistics Center. The general manager of which is Savo, whom you know very well, and Milan Trajković, who is wondering whether the Pink television is here because they like to broadcast him, but inflation report is not so interesting, so they do not broadcast it so much. And we also have Nikola Dragašević, whom you know. He's the general manager of the Monetary and Foreign Exchange Operations Department, and everything relating to the exchange rate and other developments. And we are ready to respond to all your questions after presenting the inflation report. Due to the set of circumstances, through presenting my colleagues, we wanted to explain to you why the inflation report is not only an inflation report, but covers broader topics coming under the remit of the National Bank of Serbia, because we do not hold press conferences so often due to the circumstances, but even in regular times, we only had regular presentations of the Financial Stability Report and the Inflation Report, which is a very interesting topic at the moment. Once again, officially, welcome to the presentation of the February Inflation Report. We will give you an overview of current economic trends, our new macroeconomic projections, as well as monetary policy decisions made in the period since the previous report. Since our last meeting in November, the global economy has been marked by geopolitical tensions, deepening energy crisis, and further growth in cost-push pressures on a global scale. In addition, we are faced with persisting problems in global supply chains and the spread of the Omicron variant, to which the leading world economies reacted differently. All of this has led to additional mismatches between demand and supply and to new inflationary pressures globally. Energy and food prices recorded a particularly sharp rise worldwide. Unlike in the previous crises, besides oil prices, the prices of gas and electricity also recorded robust growth in international commodity exchanges. global strengthening of cost-push pressures and the spread of the Omicron variant in our key foreign trade partners led not only to the upward revision of inflation projections, but also to a slowdown in economic activity and a downward revision of GDP growth projections. Despite unfavorable circumstances in the international environment, the MBS kept its November projection of real GDP growth for this and the following years. In 2020, as well as in the medium run, GDP growth is expected at the 4 to 5% range, with the central projection in all years measuring 4.5%. Overall, risks to the projection are judged to be symmetric, and as so far, those from the international environment are tilted to the downside, and those from the domestic environment to the upside, including primarily government investment and increasingly better results in attracting FDI inflows. Besides, it will be easier to achieve the 2022 projection as we are building on excellent trends from the last quarter of the previous year, in which, despite the slowdown in the euro area, Serbia recorded real GDP growth of 6.9% year-on-year, or 1.6% seasonally adjusted, relative to the third quarter of 2021. This was largely a result of the record level of government investments, but also foreign direct investments, whose inflow in 2021 reached 3.9 billion euros and thus surpassed the record high from the pre-pandemic 2019. Over the past few weeks, we have had the opportunity to see that, contrary to the early expectations of market participants, year-on-year inflation in most advanced and emerging economies increased further. Euro area inflation rose from 5% in December to 5.1% in January, reaching double-digit levels in some euro area members. Although this does not, at first glance, confirm the assessments of leading central banks about the temporary nature of current inflation, one should bear in mind that in most countries inflation is still largely driven by rising energy and food prices. Also, there are countries that are faced with high core inflation, both due to the strengthening of depreciation pressures on their national currencies and the overheating of their economies in the pre-pandemic period. As for inflation in Serbia, according to a new projection, we expect year-on-year inflation in the first quarter of 2022 to move around the December level of 7.9% or slightly above it, and then to decline from the second quarter onwards and settle in the range from 3.5% to 4% at year-end. Going forward, it is expected to slow down further and move around the target midpoint until the end of the projection horizon. The effects of the new agricultural season will contribute the most to the slowdown in inflation, as they will directly affect the prices of fruit and vegetables, and for lower production costs, the prices of processed food as well. We expect that a gradual exit from the pandemic will help reduce the supply-demand gap globally and solve the problem of halts in supply chains, which could consequently lead to lower cost-push pressures. An important factor of lower inflation will be the expected subsiding of cost push pressures on account of the prices of oil, gas, electricity, and primary agricultural commodities, according to futures, as well as the dropout of last year's hikes in petroleum product prices from year-on-year calculations. As any other projection, this projection carries its own risks, which are associated mostly with the international environment and are slightly skewed to the upside. My colleagues will explain them in more detail later on. Amid stronger cost-push pressures and the need to impact inflation expectations and prevent the second-round effects of rising global food and energy prices on other products and services, the National Bank of Serbia continued tightening monetary conditions. As a reminder, last October, the National Bank of Serbia began a cycle of increasing the effective repo rate, the interest rate at which we have implemented repo transactions for years, since December 2012, making the best use of the flexibility of our monetary framework. From October until today, the effective repo rate was increased from 0.11%, as it was then, to 0.79%, where it stands today. The increase in the repo rate so far is almost equivalent to 3 key policy rate hikes of 25 basis points each. In making these decisions, we made sure that our monetary policy is consistent with achieving price stability in the medium term and that financing conditions remain favorable from the aspect of ensuring continued stable growth in credit and overall economic activity. Core inflation, which is affected the most by monetary policy, moved within the target tolerance band the whole last year, averaging slightly above 2%, while at the end of the year it measured 3.5%, which is lower than in the majority of Central and Southeast European countries running the same monetary policy regime as Serbia. The key reason for the lower core inflation in Serbia is the fact that we maintained relative exchange rate stability, keeping not only core inflation under control, but also providing a key contribution to the maintenance of business, consumer and investment confidence, which is the most important prerequisite for dynamic and sustainable economic growth. Coupled with a robust and timely package of monetary and fiscal policy measures, it was preserved confidence and production capacities that made Serbia achieve, despite unprecedented challenges, one of the best results in Europe in terms of GDP growth, which amounted to 7.5% in 2021 and 6.5% cumulatively during the 2 pandemic years. Speaking of economic growth outlook and its drivers, let me present several data that did not get the deserved attention in the public. Above all, exports, which outperform our projections year after year. In the last 2 years only, goods and services export increased by over 20%, from 23.3 billion euros in 2019 to 28.6 billion euros in 2021, thus reaching 53.9% of GDP. Exports would have been even higher had it not been for the problems in global production and transport chains. The major part were manufacturing exports that reached 19 billion euros, as well as exports of services in the most propulsive segments of the economy, such as information communication technologies, business, transport, and tourist services. The current account deficit ended 2021 at 4.4% of GDP, only slightly above the 2020 level, despite the equipment imports reaching record high 4 billion euros, and despite the extraordinary energy imports by year-end. This is yet another indicator proving that we are much better equipped for the challenges that we are clearly bound to face throughout this year as well. Our increased resilience is also testified by the record high level of the country's foreign exchange reserves. At end 2021, gross foreign exchange reserves amounted to 16.5 billion euros, up by 3 billion euros from end 2020. Net FX reserves in 2021 came at 13.7 billion euros. Let me share with you the information that at this moment our vaults hold close to 2 billion euros in gold, whose quantities continuously increase, measuring 37.5 tons at the end of January. The reduced need for external financing is evidenced also by the plans to reduce the fiscal deficit and switch to a primary surplus in 2024, and the fact that the share of general government public debt in GDP was put on a declining path already last year, measuring 57.5% at end 2021 for the general government and 56.9% for the central government. In 2021, for the seventh year in a row, the current account deficit was covered by net inflow of foreign direct investments, which is expected to continue in the years ahead. Foreign direct investment inflow in 2021 amounted to 3.9 billion euros, remaining mainly channeled to tradable sectors. Private investment growth on the back of preserved confidence and stable sources of financing, with the continued implementation of government-financed infrastructure projects, will push the share of total fixed investment in GDP to 25% from the last year's 23.7%, and ensure its continued rise in the years beyond. Favorable trends continued also in the labor market. The average formal employment in the private sector in 2021 stood at 1,670,000, up by almost 100,000 compared to the pre-pandemic 2019. The greatest employment gains were recorded in the sectors which are the most important from the aspect of economic growth and development: manufacturing, 34,000, construction, 15,000, and private sector services such as ICT services, trade, transport, tourism and catering. At the same time, the average wage in the Republic of Serbia increased by 18.5% in the last 2 years, driven mainly by the private sector wage growth of 19.2%. The preserved labour market in pandemic conditions and a further rise in employment and wages are the most significant sources of financing of personal consumption, which is expected to continue up on a stable and sound basis, contributing to economic growth, but not excessively and without generating major inflationary pressures. Thanks to the preserved trust and full financial stability, the financial sector has continued to provide funding for new investment and consumption, thus supporting economic growth. In the past few years, Serbia recorded almost double-digit growth rate in lending, more precisely 9.9% in 2021, financed to a significant degree by the record high levels of foreign exchange and dinar savings of the private sector. The dinar savings, which reached 105 billion euros, and FX savings, which reached the amount of 12.9 billion euros, which is the latest operational data available, and it is our pleasure. The dinar savings are growing at a more robust dynamics than FX savings, though both are rising. The rise in lending is the best result of increasingly better performance of the banking sector, evidenced by the high capital adequacy and the share of NPLs, which reached 3.5% in December, down by 0.7 percentage points from the pre-crisis level at end 2019. Ladies and gentlemen, dear colleagues, let me repeat what I emphasized in public many times before. Serbian inflation is currently determined by energy and food prices. These are supply-side factors which can be impacted by monetary policy measures only slightly or not at all. The National Bank of Serbia cannot reduce the global price of oil or other energy products, nor can it impact the prices of all those agricultural products that are traded in commodity exchanges. What the National Bank of Serbia can and does do is to prevent that the effects of these elevated prices spill over via inflation expectations onto the prices of other products and services to a large degree. It is also important to point out that the President and the government of the Republic of Serbia have ensured that our country pays one of the lowest gas prices and that electricity hike for the corporate sector, while relatively high, is still one of the lowest in Europe. The prices of basic foodstuffs were also capped, and some of the market segments responded favorably to commodity reserve interventions. The government's decision to cap petroleum product prices will also exert an important effect on market developments. On our part, by preserving the stability of the exchange rate of the dinar against the euro, we managed to ensure that a spillover of growing import prices of energy and food to other prices is not additionally heightened by the effects of dinar depreciation, as was the case in prior episodes of high growth in these prices. For the sake of comparison, and I wish to highlight this in particular, during the previous crisis and the price shock in the period from 2010 to 2012, the adverse effect of the price hike in the international environment on Serbian prices was tripled as a consequence of the strong depreciation of the dinar against the euro. Let me simplify. 2/3 of the problems with imported inflation we had struggled with from 2010 to 2012 originated from the dinar's depreciation against the euro, and only 1/3 from the price rise in the international environment. We have not allowed that to happen this time, and thanks to that, we still keep core inflation under control and indicators of business and investment confidence at high levels. In the coming period, we will continue to carefully monitor and assess factors in the domestic and international environment, which will determine our future decisions and moves. You can rest assured that the Serbian government and the National Bank of Serbia will conduct a consistent and responsible economic policy, doing everything in their power to see our economy grow even stronger and more resilient to future challenges from the international environment. Medium-term price and financial stability remain the National Bank of Serbia's priority, because that is the best way for the central bank to contribute to sustainable economic growth and to a rise in employment and living standards. I will now give the floor to my colleagues from the Economic Research and Statistics Department to give you a detailed account of our new projections. And I will explain later how we responded, taking into account all circumstances, just as we responded at the start of the pandemic, without panicking, but promptly, readily, by taking adequate measures, without exhausting all our instruments at the very first moment, because we can do this due to our built credibility and our experience in the past decade.
We shall now present to you in more detail our new macroeconomic projections of GDP and inflation and the expected movement of the underlying key factors from the domestic and international environment. As Governor Ergomanka Tabakovic stated in her introductory address, GDP maintained a relatively strong growth dynamics in Q4 2021, and according to estimates of the Serbian Statistical Office, posted growth of 6.9% year-on-year. This exceeded our expectations and resulted in real GDP growth at annual level, measuring 7.5%. On the production side, such growth was mostly aided by the service sectors, which suffered the most in the first stage of the pandemic. Then the construction sector, manufacturing, despite the persisting challenges in terms of halting global supply chains, and mining. The only negative contribution to growth came from agricultural production, which recorded a fall of 5% due to drought. According to NBS estimates, quarterly assay growth in Q4 equaled 1.6%, whereby at the end of the year, GDP was more than 5% above the pre-crisis level, that is the level from Q1 2020. Also, it is important to note that faster than expected economic growth in Q4 2021, on account of the carryover effect, which is estimated at around 2%, is what makes our GDP growth forecast for this year more certain. With this in mind, all the leading financial institutions, the IMF and the World Bank, assess global economic growth outlook for this year as somewhat less favorable than 3 months ago. We still kept Serbia's growth projection within the 4 to 5% range, which is the same as our medium-term expectations. According to our estimates, thanks to a further increase in employment and wages and a favorable lending environment, we expect the biggest contribution to GDP growth to come from private consumption, which is estimated to rise more slowly than total GDP in the coming period, thereby making economic growth sustainable in the medium run. We also expect fixed investments this year, as well as in the medium run, to maintain a relatively strong contribution to growth, which will be facilitated by the realization of announced infrastructure projects projects in road, railway and utility infrastructure. The key private investment growth factor are still own sources, which were preserved despite the rise in production costs on account of the increase in the prices of energy and raw materials. Of particular importance for preserving own sources of financing was the fact that during the outbreak of the pandemic, as well as afterwards, production capacities and jobs were preserved owing to timely and comprehensive support of monetary and fiscal policy measures. Growth in private investments is facilitated by the preserved macroeconomic stability and a favorable investment environment reflected in a high FDI inflow. Year after year, FDI inflow is exceeding our projections, and even more importantly, these investments are diversified across projects and mostly channeled to tradable sectors. All of the above should result in the share of fixed investments in GDP exceeding the desirable level of 25% this year and continuing to increase. Investments from previous years boosted our export supply, which, aided by the normalization of global economic flows and recovery of external demand, contributes to high export growth rates. In conditions of stepped-up equipment import for the purpose of realizing the above investment projects, this and the following 2 years we expect a mild negative contribution of net exports. Nevertheless, we expect the share of the current account deficit in GDP to be relatively stable and remain below 5% over the medium term, as well as remain fully covered by the net FDI inflow. Overall, risks to the GDP projection are judged to be symmetric. As in previous projections, risks from the factors emanating from the international environment are still slightly more skewed to the downside, while those in account of factors from the domestic environment are slightly tilted to the upside. In terms of factors from the international environment, the key downside risk to our manufacturing and exports includes longer than expected halts in global supply chains and the continuation of the energy crisis. Consistent with the estimates of relevant international financial institutions, we assume that bottlenecks in most production sectors will be gradually eliminated during the year and that the natural gas price will begin to decline as of spring, though problems associated with the gas price globally might persist longer than expected. However, owing to the agreement signed with Russia, which will remain in force until mid-2022, that is during the period with the highest risks from the hike in the global price of gas, Serbia will pay most of its gas at a price unchanged from last year. Hence, we do not expect any major disruptions in the functioning of the local economy on this account. The price of electricity for local corporates has indeed increased, but we must bear in mind the fact that many companies signed more favorable long-term contracts with the electric power industry of Serbia. Therefore, they do not incur higher costs for electricity. Another thing that needs to be highlighted is that the price of electricity for corporates has been limited by government measures to 75 euros per megawatt hour for the next 6 months, when pressures towards its growth in the global market are likely to be the most pronounced. In addition, it should be noted that in case of the high prices of gas, the external competitiveness of domestic companies would most likely be preserved, because rival companies in the EU are faced with a much bigger increase in gas and electricity prices. As for domestic factors, we think larger, possibly higher than expected rise in fixed investments, which are the healthiest source of GDP growth, as they also boost potential output. Above all, we believe that the FDI inflow could exceed our estimates, which are traditionally conservative. In addition, we believe that government fixed revenue defined by the fiscal strategy, which we used as a projection assumption, is projected conservatively, and that its better realization would open up additional room, which would be used mainly for growth in government capital expenditure. I will now briefly present our new inflation projection. Over the past days and months, almost all central banks revised up their inflation projections as cost-push pressures turned out to be more inflationary and durable than initially expected. Central banks concur in their estimate that elevated cost-push pressures on account of the prices of energy, food and industrial raw materials, including disturbances in supply chains, will generate inflationary pressures in the short run, but to a lesser extent than so far, as most of these costs have already translated onto consumer prices. In the second half of the year, a significant slowdown in inflation is expected. Our expectations are consistent with this. Under our new projection, headline inflation in Q1 this year will be at a similar or slightly higher level than in December, when it measured 7.9% year-on-year. We expect inflation to reach its peak most probably in February, whereafter it should be declining until the end of the projection horizon. The inflation slowdown will be encouraged primarily by the dropout of last year's hikes in petroleum product prices from year-on-year inflation, while in the middle of the year, the onset of the new agricultural season should result in a reduction in the currently high prices of fruit, vegetables and raw materials in processed food production. Moreover, in line with estimates of leading international financial institutions, we expect the weakening of the effects of higher cost push pressures from the international environment on various grounds. Global primary commodity prices, halting global supply chains, prices of international transport, producer and import prices, although all these factors in the new projection generate more inflationary pressures compared to the previous projection. Under our new projection, year-on-year inflation will measure from 3.5% to 4% by late 2022, whereafter it will continue to slow and move around the midpoint. Since GDP growth in 2021 exceeded our expectations, the question of the impact of domestic demand on inflation can be raised. According to our estimate, in the inflation projection horizon, that is in the next 2 years, disinflationary pressures on account of aggregate demand will gradually wane. However, we must emphasize that in addition to economic growth, our production capacities are expanding as well, which means that demand growth is accompanied with supply growth. That is, neither in the projection horizon nor in the medium run will there be a risk of an overheating economy. Along with preserved relative stability of the exchange rate, this contributes to lower core inflation than headline inflation and its more stable movement. Uncertainty concerning the achievement of the inflation projection is still mainly associated with the international environment and relates chiefly to the duration of halts in global supply chains and the energy crisis, movement in the global prices of energy and primary agricultural commodities, and the normalization of the monetary policies of leading central banks. Currently, one of the greatest global uncertainties concerns the movement of crude oil prices, which stepped up since the start of the year. However, market expectations based on futures prices still indicate that these prices should decline this and in the next 2 years. The risks to the inflation projection are partly associated with the domestic environment as well. Primarily the next agricultural season, the dynamics of domestic demand and administered price movements. When it comes to the domestic food prices, their further movement will also largely depend on the next agricultural season in Serbia, which for projection purposes is set at the level of a 5-year average. In case of an agricultural season that would be above or below the average by late this year, inflation could get close to the lower or higher bound of the NBS target tolerance band, which equals 3 plus minus 1.5%. At the end of my today's address, I would like to highlight that the February inflation report contains 5 text boxes on current topics. In the first text box, we compared the contribution of rising prices of food and oil to inflation in 2021 with the previous episodes of their high rise in the global market. The second text box analyzes the pandemic's impact on the balance of savings and investments. The third text box elaborates on how global production and supply halts reflected on the performances of manufacturing and its exports in 2021. The fourth text box is devoted to the macroeconomic effects of the global energy crisis on Serbia. In the fifth text box, we showed how different types of price shocks reflect on year-on-year inflation, and we illustratively explained why we expect inflation to be on a downward trajectory this year. We believe that these text boxes and the report, which is before you, will give you additional explanations of the impact of global and domestic movements on inflation and the country's economic growth.
Before Dragica gives the floor to members of the press, I wish to reiterate something that I find very important regarding how the National Bank of Serbia, in contrast to leading central banks of the most advanced countries, responded to inflation, which suddenly became a topic current on all forums and which is of concern for monetary policy makers. Regardless of our awareness that we are not a large country, for us Serbia is the most important, the largest country, and for this reason, the same as in the pandemic, we took measures promptly but gradually, keeping a close eye on all developments in the international environment that affect us. And what does this mean? We stopped additional provision of dinar liquidity promptly, without delay, and we tried to make sure that a different quantity of dinars available to some banks and not available to other banks, we tried to make a connection between these two types of banks, and the National Bank of Serbia and the Monetary Policy Department and the Banking Supervision held a series of meetings with banks and tried to channel them towards mutual trade, as our effective repo rate introduced in our system of variable repo auctions in December 2012. Since October this year, we started tightening our monetary policy by raising this repo rate from 0.11 until and including Wednesday, when these one-week repo auctions are held. We raised this rate to 0.79%, which is almost the equivalent of 325 basis points hikes. We have tightened our monetary conditions, and this would mean that we have not only made the price of money higher in the interbank market, but we have also increased the withdrawal of dinar liquidity in absolute amounts, where until recently the absolute amount of dinars we withdrew was 40 billion dinars, and in the latest repo auction in Wednesday we withdrew 136.8 billion dinars from banks, not overnight but on a 7-day basis. But this is something that should not make financing conditions and lending activity towards the corporate and housing sector more difficult at any point. Let me speak in percentage terms. In the period from September, since September, we withdrew so far until then 30%, and since then till present date 76% of excess liquidity in the system is withdrawn by the National Bank of Serbia, thereby leading to a tightening of monetary policy without raising the key policy rate, which remains at 1%. Why am I emphasizing this? Because all the time, by not allowing for the practice of negative interest rates to be introduced in Serbia, and for excess cheap money in which the global economy swims should spill over to Serbia in the worst possible way by demotivating savings, while providing such excess amount of money to investors that they would not know what to do with it, we have preserved what we what we have always emphasized in our speech is the consumer confidence, but also credibility towards all investors who see Serbia as a favorable investment destination, because low interest rates or zero interest rates or money which is not earned but spent has both its losers and its winners. The losers are those who keep and have savings, 105 billion dinars, 6 times higher dinar savings relative to 2012, and 12.9 billion euros foreign exchange savings. And this is the soundest source of economic growth, because at a time when leading central banks decide to raise their interest rates or to reduce the amounts of subordinated cheap loans to their subsidiaries in Serbia, Serbia should not have problems because of that. Why? Because economic policy is not pursued by making sharp turns. A sustainable economic policy is pursued by taking prompt actions, but in a calibrated and gradual manner, keeping an eye on not only we who are sitting at this table, but all our associates are keeping a close eye on all events, on all advantages and disadvantages of the measures that we take, especially since 2000 onwards. That is why we are taking decisions in which we're not being irresponsible by taking swift and sudden decisions and losing our potential and ability to respond. We are not criticizing the European Central Bank, which is said to be doing so little and so slowly. If I remember, this was said by Ms. Christine Lagarde, too little, too late, when she discussed Europe's response with regard to vaccines and the pandemic. No, everyone is pursuing their own policy, and it is not easy for Ms. Lagarde to take into account the interests of different countries with pronounced specificities of their economic structures and the circumstances in which they work. And when I mention the circumstances, I'm referring to the structure of their economy, what they have inherited, and also even the history of inflation. Because if you want to admit that or not, economy is for a major part also sociology, and this is why we are trying to influence inflation expectations, and we are satisfied that inflation expectations are within the bounds of the target tolerance band in the medium term. And I wish to thank all major retail chains which responded to our invitation. We also held individual meetings with them to see how they perceive future developments with regard to inflation, import costs, environment in which they're working. And I can tell you that with great precision we are able to assess the results that we will be receiving next month when it comes to inflation. Because I'm very happy about the responsible approach of these retail chains who are doing their own research on inflation, consumer behavior, but each one of them at the beginning or at the end of the meeting emphasize the significance of stability of the exchange rate in order to prevent the spillover of these effects that are beyond our control. In this way, I wanted to say that the National Bank of Serbia is not only someone who says they know what they're doing. We are taking into account the circumstances, our history, and we are making an effort to ensure better living standards for all citizens. And the results are the following.
The minimum price of labor rose at the annual rate of 9%, and the minimum wage rose from 21,000 dinars in 2016 to 35,000 dinars in early 2022. This is a growth of 67%. At the same time, the average annual inflation in the period from 2017 to 2020 equaled 2.1%. In 2021, average inflation measured 4%. And based on what I have said, it is clear that the minimum wage increased not only in nominal terms, but also in real terms by over 50%. And I will give you a bit more these irrefutable data, and I will show you how we managed to ensure through such coordinated monetary and fiscal policies the coverage of the average consumer basket by the average wage in the Republic of Serbia and the coverage of the minimum consumer basket as well. And it looks as follows. The coverage of the average consumer basket by the average wage in Serbia from 2016 until late last year went up from 66.5% to 84.6%. And in the same period, the coverage of the minimum consumer basket increased from 60 to 80.9%. Yeah, it's still not 100%, but this is our objective for sure. And with such growth dynamics and development of the Serbian economy, and with such the pace of wage growth, we expect that in the coming next years, we will reach the full coverage of both types of the basket. And the second part of the story, or the first part of it, is actually the increase in formal employment. I wish to emphasize that it has been going up, and the number of people earning wages in the private sector since late 2014 until December 2021 increased by 316,000 persons, and this is an increase by 23%. These are the figures that I wanted to present. This is the contribution of the National Bank of Serbia to a better life in Serbia and to a rise in the living standards of our citizens. I would like to thank my colleagues who have allowed me to give this brief overview before they say what they have to say. I believe that this is very important to emphasize. I wish you, I wanted you to hear this, and if you want to present these data, we have our colleagues, our Dragica here as well. We can help you to precisely inform the public, because one of the best ways of keeping the trust that we have and to somehow subdue the negative psychological effects is to communicate clearly in the way that our central bank has been sending clear signals all the time without any noise in terms of the monetary policy measures that it will be undertaking. I apologize, we haven't seen each other for a long time. I tend to speak a bit longer usually. Dragica, if anyone has any question, please ask the question. Nenad Nešić, and one. Could you be more succinct and shorter, please, now? You mentioned the meetings with retail chains. When people listen to the figures, I believe they don't understand anything. Let's try to be more concrete. What about food prices and the projections? Last time you mentioned the example of the price of coffee, because people understand these things in that way. They go to a shop and see the prices. The second question relates to interest rates. Will they go up? Will the ECB raise its interest rate? Thank you. Thank you for your question. Well, I'm someone, regardless of my function, I'm someone who doesn't like to be ordered to do things. Of course, we are independent as a central bank, and in communication, I don't like such instructions to be succinct and shorter. In economics, you can't give short answers, yes or no. If I give you figures in decimal places, well, I'm being completely precise, so this instruction was perhaps superfluous. Sava can elaborate on this. The food price rise of 20% is not inflation of 20% because food prices are only a part of overall inflation. And as for interest rates, perhaps Mira can tell you something, and Milan as well. We hope that Pink will broadcast his explanation. So you're shorter than me, but in your own way, Milan, please. Thank you, Madam Governor. I would not like to underestimate the public. I believe they do understand the figures. These figures are really simple and people understand them. When we say headline inflation and we say a hike in food prices, this hike is a part of headline inflation. December year-on-year inflation measured 7.9%. The increase in food prices is only a part of it. Food prices account for 11%, that is unprocessed food, and unprocessed food around 20%. Unprocessed food, December on December, these prices went up by 20.9%. And in the public, there is the belief that statistics do not record what is going on. So yes, statistics have recorded this increase. So the prices of fruit and vegetables and fresh meat have gone up. When it comes to processed food prices, this increase was 8% last year. So what are the main underlying factors? World food prices, first and foremost, in the last 1 year or two, since the pandemic broke out, and then economic recovery ensued, world cereal prices went up by 45% on stock exchanges, and the prices of our wheat and corn go up as well. Then soy and sunflower went up. Their prices went up by 80% at the global level, and this affects your prices of vegetable oil and so on, and soy also affects other food prices. World milk prices went up by 30%, sugar prices went up by 30% as well. These are all stock exchange commodity prices, so these prices spill over directly to the domestic market because we are liberalized in terms of exports and in terms of import as well. We also had another factor which is impossible to influence from the aspect of the National Bank of Serbia, and this is the drought. So the drought brought about the situation when we also witnessed a rise in prices of domestic fruit and domestic vegetables. So as for the coming period, with the onset of the new agricultural season, where for the production needs we assumed it would be average, somewhat better than the previous one, and the prices of unprocessed and processed food should decline. This particularly holds for Q4, but primarily Q3 and Q4 this year. And this is one of the main reasons why we expect year-on-year inflation to return to between 3.5% and 4% until the end of this year. And the agricultural season is the key here. If it turns out to be better than the average one, until the end of this year, inflation could be below 3%. But if we again have a drought, and we believe it would not take place, inflation would stay at the levels, let's say, around the upper bound of the target tolerance band. So it all depends on that, and it all depends on world prices as well.
When it comes to your second question relating to the policy of the European Central Bank, the ECB has still not announced an increase in its policy rate this year. It began downsizing the volume of its quantitative easing, but there are still no announcements for this year that there will be an increase in its policy rate. What the ECB is emphasizing is that favorable financing conditions are still necessary in order to ensure a sustainable growth over the long term. So although even if there is an increase in the nearer future, this increase in the policy rate should not be sudden and should not be great, and it should not reflect to any major degree to the price of euro index loans in Serbia. Also important to note is that not only Euribor is influencing the price of euro-indexed loans in Serbia, and other factors include credit rating, competition in the domestic market. Standard & Poor's late last year raised our outlook for a rating upgrade of Serbia. So in a nearer future, we also expect an increase in our credit rating to investment grade level, which would mean much more favorable financing conditions for both corporates and households. So there are no announcements for the time being, and if we look at futures in the Euribor, 3-month Euribor, they are still projections are still that they should be in the negative zone late in the year as well. If we take into account that the dinar will remain stable, we have seen that the cost of keeping the dinar in a very narrow range against the euro. In the first quarter, it cost a lot. In January, still more. How do you see this going forward? How can you make sure that defending the dinar is not costly? I will give floor to Nicola so he can give a more detailed explanation. But if we say that we faced this crisis, that we were ready when this crisis broke out, this means that the foreign exchange reserves we have created by buying the euro in the interbank foreign exchange market in order to ensure that the dinar would not strengthen too much against the euro. We created in this way reserves that enable us today to intervene in the FX market in the opposite direction at the time when it is needed to preserve a stable exchange rate, and also to provide to all those who need this, including primarily energy importance, with enough foreign exchange assets, which in the fourth quarter and in January amounted to close to 1.5 billion euros. This was paid for imports. You call this, no, you said this, you said that this is a cost, an expense, but it is, but it's also an investment. At no time, no single industry had a problem with a shortage of energy. Production was not discontinued due to shortages of electricity, for instance, or because the price was so unstimulating that it was not profitable to produce. As I always said, we are investing in this instability by using foreign exchange reserves for interventions. In the same way, you said this costs, but it also pays off, because 3.9 billion foreign direct investments in the past year. This is higher by 3.4% than in pre-pandemic 2019. January and February last year was 222 million euros of foreign direct investments in January and February last year. This year, January and the first decade of February saw 320 million euros in foreign direct investments. So only in the first decade of February alone and in January we are close and we are comparable to last year's record year in terms of investment, foreign direct investment, which means that it is profitable what is called.
Thank you. I will give you a few details. You asked whether it is expensive to maintain stability. The governor said that this means investment in stability and that we timely prepared our reserves since 2017 to 19. Our reserves in terms of NBS interventions went up by 5 billion euros in net terms, and in 2020 to maintain stability. This was the year of unprecedented uncertainty, meaning elevated uncertainty due to economic effects of the pandemic. The NBS net sold 1 billion and around 1 billion and 1,450 million, and then appreciation pressures continued, and at the level of the year, the NBS net bought 445 million euros. In the first 3 quarters, in the first 9 months of that year, the NBS bought 1 billion and 100, and had it not been for the energy situation or the energy crisis, we would have continued to buy FX in the market. Why? Well, in Q4, we sold 455 million net, and there is only one factor that can be characterized as the key one, which acted towards depreciation pressures, that is our need to sell FX foreign exchange. This is the energy crisis. An increase in the prices of energy and the stepped-up need to withdraw, that is to buy a high amount of energy, exerted a twofold impact on the quantity of foreign currency, and 3 main energy importers had an increased demand for them. I will just present you data. In Q4, these 3 companies, NIS, APS, and Serbia Gas, bought in net amount over 1 billion, that is 1 billion and 24 million euros. All other residents, domestic companies, were net sellers of foreign currency, meaning that other flows were untouched, meaning that smooth functioning continued and the structural appreciation effect continued. In order to compare what would have happened if demand for FX of energy importers had remained at a usual level, I'm not talking about 2020 when it was lower, but about 2019 when it was which is a better year for making comparisons. The first 3 quarters of 2019 and the first 3 quarters of 2021, the net demand of these 3 companies for FX was almost the same, 1 billion, 1 billion and 100. The fourth quarter of 2019 saw demand of 465.5 million euros. Net demand was over 1 billion in 2021. If we didn't have such elevated demand for FX, the NBS would not have sold 455 million, and in the fourth quarter it would have been a net buyer of foreign currency. It would have bought around 100 or 105 million, and after January, already in February, we can see a lower demand for foreign currency of these companies, and this speaks about our expectations in terms of the exchange rate and pressures. We expect the normalization of these flows, and if other factors continue to be appreciation factors as in the previous years, we expect that this year we will have the reasons to buy foreign currency in the remainder of the year. And now I would like to add something. I would like to complete Nicola's sentence. billions. So we can illustrate this through exports. We have 5.3 billion euros. This is the increase in exports from 2019 until 2021. So this is the FX inflow. That is the net sellers who somehow subdued this demand for foreign currency. So energy, gas and electricity are not being bought to be stored somewhere, but in order to produce, in order to work and to export, which results in the inflow of foreign currency, which equals 5.3 billion euros more than the exports in the period 2019-2021.
Our job today is regarded as an ecosystem in which the economy as a whole needs to function in such a way that all participants make a contribution and see the benefit from what we are doing. What could you do in this respect depends on, if we measure this by savings, I can tell you that dinar savings are growing and they have risen to 105 billion dinars. So this mismatch that you're discussing is not something that concerns anyone. We will keep inflation within the bounds of target tolerance in the medium term because we are not doing this day by day, nor are measures taken this way, nor can they be effected in this way. So the manner in which we measure the cost and the benefit is something that is very important in our work. And though our Danilo and Mr. Atsatomin, with their entire team, are applying the latest models to produce the projection of medium-term inflation, there are some of us who have experience and a sense of things, and so we adjust this together to real life when we present our projections to you. But in this, by reviewing things in this way and by measuring whether we are taking all the measures we can, I think that in this way we have produced these results and have built our credibility. I would not like to mention the example of the Czech Republic or high core inflation or the measures they are taking. We are only looking at our own circumstances, at our own country. We are not setting any tasks for others, but we are doing our job in coordination with all other policymakers. And when it comes to provision of foreign exchange for importance of energy, we have direct communication. We have had it for a decade with full confidence that we know all details regarding who needs what, in what way, how procurements are made, and regardless of the challenging circumstances and the need for foreign exchange for importers of energy, for imports of equipment, for investment, the government of Serbia and the National Bank of Serbia have made sure that those working in Serbia and founded by founders abroad, $1.017 billion of dividend was paid to their founders, shareholders outside of the Republic of Serbia without any restrictions, which is another indicator of confidence in Serbia, which I believe through the credit rating, through the risk premium, through all talks we have, not only with foreign agencies assessing our credit rating, but also with investors, will continue to be important, because these are the figures that they can easily monitor, especially now that we are included in JP Morgan's index. And when someone says they do not understand, or citizens do not understand things concerning inflation, we do not wish to burden our citizens with the number of jobs and the tasks that the National Bank of Serbia is doing. We want to make sure that we have positive results, and all we expect from citizens is that they trust us, because we really know what we are doing. And by presenting these figures, I'm saying that the National Bank of Serbia has made sure that everyone has enough foreign exchange at their disposal, and our foreign exchange reserves have decreased somewhat at the end of the year. But with this trend of the opening of factories, jobs, payout of earnings and investments, I have told you what trends are in January, February. We expect to return to the trend of preventing the strengthening of the dinar and of trying to impact appreciation pressures, and again building up our foreign exchange reserves, and also buying gold, I hope, whose price is rising once again. Yesterday it was around $1,900 per ounce. The dollar is strengthening, the value of the gold is strengthening, but safe assets are in Serbia.
RTS Vojvodina. Unlike the ECB, the Fed raised its interest rates, and it may do that several times this year. How will this reflect on Serbia's debt, and how many loans are due this year? Thank you. I have to say that the Fed has still not started to raise its Fed funds rate, which is still at the lowest levels ever. And of course, everyone, all market participants and all countries are looking at the Fed and their decisions. As for some possible announcements, in March they may raise the rate for the first time, and they will say how many times they will increase it. As for the impact on our developments at home, the stability that we have ensured in the FX market and the overall financial market will continue, and we don't see any significant exit of foreign portfolio investors. So non-resident investors are not leaving the country. They're still interested in our dinar securities. We do not expect that this would have any major negative effect on the FX or market or the overall domestic market. Of course, all central banks will carefully monitor their decisions and global capital flows, and they will decide on their key rates as well, and further monetary policy dynamics. And it will not impact us so much, because we acted in time and we linked the structure of debt to the safe currencies, meaning the euro. Yes. As for the structure, the currency structure of debt for years back, the government of Serbia and the NBS have been working on it together, and the debt is being more sustainable, meaning that its exposure to FX risk is lower. The share of the dollar during the year has been reduced from around 30% in 2016 or 17 to the current level of 10%. So this is the share of dollar debt in our total public debt, whereas the share of the euro can be viewed along with the stability of our exchange rate, and it is almost equal as the share of the dinar, and the share of the dinar is around 33% in total public debt. So the exposure of public debt to this volatility, exchange rate volatility of the euro against the dollar has been reduced, further reduced. In the past years, the government has concluded several hedging transactions whereby public debt is being hedged against FX risk, and this boosts sustainability and lower exposure to the volatility in the foreign markets. If you don't have any further questions, I would like to thank you for coming here today. And once again, if you need any further information or you have some, you would like some figures to be clarified, please address our Dragica and other colleagues. We are here to answer all your questions. Thank you very much.